No Command Pictures presents Forex Video Training Series, Black Belt 4th Degree, Currency Correlation. What is currency correlation? Have you ever noticed that when a certain currency pair rises, another currency pair falls? Or how about when the same currency pair falls, another currency pair seems to copy it and falls also? If you answered yes, you just witnessed currency correlation in action. If you answered no, you need to stop doing less important things like sleeping, eating, playing Farmville or Angry Birds, and instead spend more time watching the fucking charts. But no worries, because we're going to start off with the basics and break it down for you. Currency correlation. The first half, easy, currency. No explanation needed. The second half, still easy, correlation. A relationship between two things. In the financial world, correlation is a statistical measure of how two securities move in relation to each other. Currency correlation, then, tells us whether two currency pairs move in the same, opposite, or total random direction over some period of time. When trading currencies, it's important to remember that since currencies are traded in pairs, then no single currency pair is ever totally isolated. Did we confuse you with our currency tongue twister sentence there? Unless you plan on trading just one pair at a time, it's crucial that you understand how different currency pairs move in relation to each other, especially if you're not familiar with how currency correlations can affect the amount of risk you're exposed your trading account to. If you don't know what the heck you're doing when trading multiple pairs simultaneously in your trading account, you will get killed, mortified, destroyed. We can't stress this enough. In this lesson, you will learn what currency correlation is and how you can use it to your help to become a smarter trader and make more responsible risk management decisions. Need me to calculate anything? Correlation is computed what is known as the correlation coefficient, which ranges between -1 and +1. Perfect positive correlation, a correlation coefficient of +1, implies that the two currency pairs will move in the same direction 100% of the time. Perfect negative correlation, a correlation coefficient of -1, means that the two currency pairs will move in the opposite direction 100% of the time. If the correlation is 0, the movements between currency pairs is said to have a 0 or no correlation. They are completely independent and random from each other. We have no idea how one pair will move in relation to the other. How to read currency correlation tables. Are you a visual learner? Perfect. Take a look at the following table. Each table shows the relationship between each main currency pair and the other currency pair over various time frames. Remember, currency correlation is presented in a decimal format by a correlation coefficient, simply a number between -1 and +1. A coefficient near or at +1 indicates the two pairs have a strong positive correlation and will likely move in the same direction. In the same respect, a coefficient near or at -1 indicates the two pairs will still have strong correlation, but in -1, resulting in the pairs moving in opposite directions. A coefficient near or at 0 indicates a very weak relationship. And another one. Another example. And another example. And another example. And again. And again, and again, one more. Always know your risk exposure. When you are simultaneously trading multiple currency pairs in your trading account, always make sure you're aware of your risk exposure. You might believe you're spreading or diversifying your risk by trading in different pairs, but many pairs tend to move in the same direction. Let's take an example of two highly correlated pairs within 1 week period, the euro dollar and the pound dollar. Based on the table you saw earlier, with a sexy correlation coefficient of 0.94, there's obviously a high correlation in the particular pair. Euro-dollar is peanut butter to pound dollar is jelly, like fish and chips, Ben and Jerry's. Okay, you get the picture. But the point is the two pairs holding hands and sing Kumbaya and skip together. To prove to you that the numbers don't lie, here are their 4-hour charts. Notice how they both moved in the same direction, down. Returning to the subject of risk, we can see that opening a position in both the euro-dollar and pound-dollar in the same direction is doubling up on a position. For example, if you bought one lot of euro-dollar and bought one lot of pound-dollar, you're basically buying two lots of euro-dollar because both the euro-dollar and pound-dollar would move in the same direction anyway. In other words, you are increasing your risk. If you buy euro-dollar and pound-dollar, you don't get two chances to be wrong. All you get is one chance, because if the euro-dollar fails and you get stopped out, pound-dollar will most likely fall and stop you out also, or vice versa. You also wouldn't want to buy euro-dollar and sell pound-dollar at the same time, because if the euro-dollar skyrockets, then the pound-dollar will probably skyrocket also, and where does this leave you? If you think your profit or loss will always be zero, then you're wrong. Euro-dollar and pound-dollar have different pip values. Just because they are highly correlated doesn't mean they will move in the same exact pip range. Volatility within currency pairs is fickle. Euro-dollar can skyrocket 200 pips, while pound-dollar only goes up 190. If this happens, the losses from your pound-dollar trade because you were short will eat up most, if not all, the gains from your long euro-dollar trade. Now let's imagine that euro-dollar was a pair that moved up 190 pips, and that pound-dollar had the bigger pips of 200 moves. You would have definitely had a loss. Going long one currency pair and short on another that are highly correlated is extremely counterproductive. In other words, don't fucking do it. More than paying for the spread twice, you minimize your gain because one pair eats into the other pair's profits. And even worse, you could end up losing due to the different pip values over ever-changing volatility of currency pairs. Let's take another example, this time with the euro-dollar and dollar Swissy. While we just saw a strong positive correlation between the pound-dollar and the euro-dollar has a very negative correlation with the dollar Swissy. If we look at the 1 week correlation, it has a perfect correlation coefficient of -1. It doesn't get more opposite than that. Instead of Ben and Jerry's, they're Tom and Jerry. Euro-dollar and dollar Swissy are like fire and water, Bugs Bunny and Elmer Fudd, Superman and Kryptonite, Boston Celtics and Los Angeles Lakers, Manchester United and Liverpool. These two pairs move in totally opposite directions. Check out the charts. Taking opposite positions on the two negatively correlated pairs would be similar to taking the same position on two highly correlated pairs. Buying euro-dollar and selling dollar Swissy wouldn't be the same as doubling up on a position. Instead, if you bought one lot of euro-dollar and sold one lot of dollar Swissy, you're basically buying two lots of euro-dollar, because if the euro-dollar goes up, then the dollar Swissy goes down, and you're basically making money on both pairs. It's important to recognize, though, that if you have an increased risk, your exposure in your trading account, if you do this. Returning to the example of being long euro-dollar and short dollar Swissy, if euro-dollar actually dropped like a rock, most likely both of your trades would be stopped out and two losses. If you minimized your losses by simply deciding to go long on euro-dollar or go short on dollar Swissy instead of doing both. On the other hand, buying or selling both euro-dollar and dollar Swissy at the same time would be usually counterproductive, since you're basically canceling each trade out. Because the trade payers move in opposite directions, like they hate each other's guts, one side will make money, but the other side will lose money. So you either end up with little gain because one pair eats into the other pair's profits, or you could suddenly end up with a loss due to each pair's different pip values and volatility ranges. Using the correlations in your trading, use the following as a guide for interpreting different currency correlation values. Everything from -1.0 to 0 all the way to 1.0. So, now you know what currency correlation is and how to read it off a fancy chart. But we bet you're wondering how to use currency correlation will make your trading more successful. Why do you need this wondrous skill in your tool bag? There are actually several reasons. Eliminate counterproductive trading. Utilizing correlations can help you stay out of positions that will cancel each other out. As the previous example explains, you know that euro dollar and dollar Swissy move in the opposite direction near 100% of the time. Opening a long position euro dollar and long dollar Swissy is then pointless and sometimes expensive. In addition to paying for the spread twice, any movement in the price would take one pair up and the other down. We want our hard work to pay off for something. Leverage profits or losses. You have to take the example of the double up to positions to maximize profits. And again, let's take the 1 week euro dollar and pound dollar relationship from the previous example. These two pairs have a strong positive correlation with the pound dollar following behind euro dollar virtually step for step. Opening a long position for each pair would in effect be like taking euro dollar and doubling your position. You're basically making use of leverage. Mucho profit if all goes right, and mucho losses if all goes wrong. Diversify risk. Understanding that correlations exist allow you to use different currency pairs, but still leverage your point of view. Rather than trading a single currency pair all the time, you can spread your risk across two pairs that move the same way. Pick pairs that have strong to very strong correlation, around 0.7. For example, euro dollar and pound dollar tend to move together. The imperfect correlation between the pairs gives you the opportunity to diversify, which helps you reduce risk. Let's say you're bullish on the US dollar. Instead of taking two short positions on euro dollar, you could short one euro dollar and short one pound dollar, which would shield you from some risk and diversify your overall position. In the event that the US dollar sells off, the euro might be affected to a lesser extent over the pound. Hedge risk. Although hedging can result in realizing smaller profits, it can also help to minimize losses. If you open a long euro dollar position and it starts to go against you, you open a small long position pair that moves opposite euro dollar, such as the dollar Swissy. Major losses averted. You can take advantage of the different pip values for each currency pair. For example, while euro dollar and dollar Swissy have almost a perfect negative 1.0 inverse correlation, their pip values are different. Assuming you trade a 10,000 mini lot, 1 pip for euro dollar equals $1, and 1 pip for dollar Swissy equals 93 cents. If you buy 1 mini lot of euro dollar, you can hedge your trade by buying 1 mini lot of dollar Swissy. If the euro dollar falls 10 pips, you'd be down $10. But from your dollar Swissy trade, you would be up $9.30. Instead of being down $10, you're now only down 70 cents. Even though hedging sounds like the greatest thing since sliced bread, it does have some disadvantage. If euro dollar rallies, your profit is limited because of your losses from your dollar Swissy position. Also, the correlation can weaken at any time. Imagine if the euro dollar falls 10 pips, and the dollar Swissy only goes up 10 pips, stays flat, or heck, falls also. Your account will be bleeding more red than you will like, so be careful while hedging. Confirm breakouts and avoid fakeouts. You can use currency correlation to help confirm your trade entry or exit signals. I will say this again. You can use currency correlations to confirm your trade entry or exit signals. For example, if the euro dollar appears to be testing a significant support level, you observe the price action and are looking to sell on the breakout to the downside. Since you know euro dollar is positively correlated with pound dollar and negatively correlated with dollar Swissy and dollar yen, you could check the other three pairs to see if they are moving in the same magnitude as the euro dollar. You notice that the pound dollar is trading near a significant support level, and both the dollar Swissy and dollar yen are trading near key resistance levels. This tells you that the recent move is US dollar related and confirms a possible breakout for euro dollar, since the other three pairs are moving similarly. So you decide to trade the breakout when it occurs. Now let's assume the other three pairs are not moving in the magnitude as the euro dollar. The pound dollar is holding, not falling. Dollar yen is not rising, and dollar Swissy is sideways. This is usually a strong sign that the euro-dollar decline is not US dollar related and most likely driven by some kind of negative euro news. Price may actually trade below the key support level you've been monitoring, but because the other three correlated pairs aren't moving in proportion with euro-dollar, there will be lack of any price follow-through, and price will return back above the support level, resulting in a fake-out. If you still wanted to trade this setup since you didn't get any correlation confirmation from the other pairs, you could play it smart by reducing your risk and trading with a smaller position size. Know that currency correlations change. The Forex market is like a schizophrenic patient suffering from bipolar disorder who constantly eats chocolates, experiences extreme sugar highs, and has volatile mood swings all day long. And we're not even fucking exaggerating. Although currency correlation between pairs can be strong or weak for days, weeks, months, or even years, they do eventually change, and can change when you least expect it. The strong correlation you see this month may be totally different next month. Compare the coefficients for a given pair across different time frames. Did you notice anything? For the most part, thanks, euro-dollar. There are different levels across the board, changing from one time to another, and they change in all directions. The lesson here is that correlations do change, and they change frequently, and at least by drastic measure in a short time frame, as apparent by looking here at the 1 month and 3 month intervals. They are the same. Because consistent sentiment shifts in the currency market, make sure you're aware of current currency correlations. For example, over a 1 week period, the difference between the dollar-yen and the dollar-Swissy was 0.22 at the very top of the chart, 1 week. This is a very low correlation coefficient and would indicate that the pairs have an insignificant correlation. However, if we look at the 3-month data, the number increases to 0.52, and then to 0.78 for 6 months, and finally 0.74 for a year. In the example, you see that the two pairs had a breakup in the long-term correlation relationship. What was once strongly positively associated in the long run has extremely weakened in the short term. They were a real couple and only dated a month or less. They would have thought they were incompatible. Little do they know, the passion will start heating up later. If you look at euro-dollar and pound-dollar, here's an example of the extent which currency correlation can change and jump around. Correlations change for many different reasons. They can include anything for a country changing interest rates, to shifting monetary policies, to any collection of economic or political events reshaping traders' sentiment on a currency. The summary. Like synchronized swimmers, some currency pairs move in tandem with each other. And like magnets, the same poles that touch, other currency pairs move in opposite directions. When you are simultaneously trading multiple currency pairs in your trading account, the most important thing is to make sure you're aware of your risk exposure. You might believe that spreading or diversifying your risk in trading different pairs, but you should know that many of them tend to move in the same direction. By trading pairs that are highly correlated, you are actually magnifying your risk. Correlation between pairs can be strong or weak, last for months, weeks, or even years. But always know that they can change on a dime. Staying up to date with currency correlations can help make you better decisions if you want to leverage, hedge, or diversify your trades. Just a few more points to remember. Coefficients are calculated using daily closing prices. Positive coefficients indicate that the two currency pairs are positively correlated, meaning that they generally move in the same direction. Negative coefficients indicate that the two currency pairs are negatively correlated, meaning that they generally move in opposite directions. Correlation coefficient values at or near +1 or -1 means the two currency pairs are highly related. Correlations can be used to hedge, diversify, leverage up positions, and keep you out of positions that might cancel each other out. Here are some examples of currency pairs that move in the same direction. And then examples of pairs that are inversely moving. When you find yourself wanting to trade two pairs that are highly correlated, it's okay if you take both setups. Just make sure you have rules in place when you trade correlated pairs, and always stick to your risk management rules.